Hello, and welcome to another episode of the Markets at a Glance series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So feel welcome. Once you join in, kindly confirm that my voice is audible. So I would really appreciate your feedback. So I know we had taken a 2-week break. Now I'm back. So hopefully you're in good hands and you had a profitable month of April. So now that we are starting May, I'm looking forward to a lot of engagements as well as volatility, and hopefully everyone goes home profitable. So as I always say, this is not investment advice, nor is it a recommendation to trade. So this is purely educational. So we will be looking at what is currently happening in the markets, try to understand the key concepts, the key developments, and at the same time, once we get through with that, we look at the key price levels in the markets. So let's begin right away. First things first, quick perusal of the economic calendar. So as you can see, Monday was basically a public holiday. It was Labor Day. Then Tuesday being today, the biggest news we have seen is the cash rate in Australia being hiked by 25 basis points from 3.6 to 3.85%, which led to the strengthening of the Australian dollar early this morning. And throughout the day, we have seen the Australian dollar being very resilient. So besides that, we also saw European inflation data. The CPI flash estimate came in higher as expected. So in the previous reading, it was 6.9%, and in this reading, it was 7%, meaning that the inflation is on the rise again in the Eurozone. So as you can see from this chart, it has been 6 consecutive months that inflation has been going down. So since the peak that we saw here, this was around, just checking, this is around 10.5, 10.7. Just want to be sure. So this was around 10.7. So since then, inflation has been going down or slowing down. So first, second, third, fourth month was sideways, fifth, and then the sixth month, we are beginning to see inflation on the rise again. So this is quite a big problem, and it basically implies that we might see the Fed going for a rate hike on its next meeting, which is happening later this week on Thursday. So this is a big signal that there's more pressure on the ECB to go for another stronger rate hike. So besides these, CPI flash estimate came in as estimated at 5.6% from 5.7% in the previous reading. And now the data that we are looking forward to is the JOLTS job opening. So remember, we had a speech from RBA Governor Stephen Loy at 2:20 p.m. So the most important data point now is JOLTS job openings. So it's a very important number that we need to know how many job openings are there in the US. And if the new job openings are rising or falling, will be a key indicator of the direction that we will be looking to see in the non-farm payrolls on Friday. So it's a big week. There's more data incoming for the week. A lot of volatility is expected. So besides the employment change tomorrow and in the morning at 1:45 a.m., most important news for the day tomorrow will be the FOMC meeting. So US interest rate data is coming up. We're expecting that the Fed will hike interest rates by 25 basis points from 5% to 5.25%, and closely followed by an FOMC press conference, which would be expected to cause a lot of volatility in USD pairs, as well as gold and oil. We also be looking to see heightened volatility on US equity indices, such as the S&P 500, the NASDAQ 100, as well as the Dow Jones 30 index. So on Thursday, most important data point will be the European interest rate data, where they expected to hike interest rates by 25 basis points, eventually pushing interest rates to 3.75%. Closely following, we'll also be looking at the ECB press conference at 3:45 p.m. And then on Friday, this is when we have both Canadian and US jobs data, with key focus being on the non-farm payrolls. So as you can see, it's a busy week. We expect a lot of announcements. So volatility is expected to be paramount. So One of the most recent developments in the market is what happened to First Republic Bank. So I remember 2 months ago, we focused on two banks that had collapsed, and this was a Signature Bank as well as a Silicon Valley Bank in the US. But now recently, and this was yesterday on Monday on a public holiday, this is when the First Republic Bank of the US collapsed. So just a brief history, if you look at what has been happening to the stock, the beginning of the year, the bank was trading at $121.54 per share. But then eventually the stock really went down, especially during the month of March. This is when we had the biggest decline, and eventually towards the close of the market on Friday, it was trading at $3.51 US. So following the close of the market at $3.51 US, the market collapsed yet again by 45.91%, which means that the opening price on Tuesday today would have been negative $1.61 dollars per share. So in order to avoid that happening, basically, according to US banking rules, the bank was put under receivership, and this was on Friday by the by the FDIC, or the Federal Depository Insurance Corporation in the US. So once it was put under receivership, they also did bidding. So it was put on auction, and several other banks presented their bids to buy out the bank. So the bank that won was JP Morgan Chase. So it won the bid to buy out First Republic Bank. So as we speak right now, First Republic Bank is no more. It has been acquired fully by JP Morgan Chase. So a brief history of the background of why and what happened is right here on a very nice article on the Reuters website. So I'll be sharing the link with you guys. So there is the link. Hello, Vandy. Hello, Nelson. Thank you. Thank you guys for joining the session. So I've shared the link to the article, but we'll peruse over it. So the focus of the US regional banking crisis turned on First Republic Bank in late March after the wealthy clients it courted to fuel its breakneck growth began pouring their deposits. So with no let-up in pressure on First Republic, the biggest US bank, JP Morgan Chase, said on Monday it will buy most of the San Francisco lender's assets after regulators says the troubled render over the weekend. So the failure of First Republic, which said last week it had first quarter outflows of more than 100 billion, marks the demise of that major US bank in just 2 months after Silicon Valley Bank as well as a Signature Bank. So what this means is that investors managed to withdraw over $100 billion from their accounts with First Republic Bank. And this was the last nail on the coffin that led the bank to receivership. So the bank was founded in 1985. So it's a more than 100-year-old bank. So it's very experienced, and it majorly attracted high net worth customers. So high net worth customers are basically people who have higher deposits, corporations, startups, and so on. So as you all know, the Federal Depository Insurance Corporation in the US insures deposits up to $250,000 per person or per company per account. So if the bank happens to go down and you have deposits amounting to $250,000 or less, then you are 100% guaranteed that your deposits are covered by the FDIC. However, if you're a high net worth customer and your deposit is more than that, then if the bank collapses, then you'll get your $250K, but for the rest of the money in your deposit account, you will have to wait until the bank is liquidated, and perhaps you get cents on a dollar. So that becomes a big, big risk, especially if there are speculations that the bank is having some weak books. So the genesis of all these started with the COVID period, when the US promised that it will continue keeping interest rates low, and basically mentioned that the inflation was just transitory and it would come back to normal. But then when inflation went really high, peaking at 9.1% in June last year, the Fed accelerated its rate hikes. And since then, the interest rates moved from around 0% to the current level of 5%. and tomorrow we're expecting another hike to 5.25%. So the effect of this hike in interest rates was one, we saw yields on US bonds rising. So with rising yields, we tend to see an inverse effect on the price of bonds that are especially the ones held at maturity. So we realized that a lot of banks in the US are holding a lot of unrealized losses, and First Republic Bank was no exemption. So gross unrealized losses in held to maturity investment portfolio, mainly government-backed debt, or basically bonds, ballooned to $4.8 billion at the end of December from just $53 million a year earlier. So if you see your unrealized debt move from 53 million to 4.8 billion, and investors are aware of this fact, then you can be guaranteed that they'll be shorting your stock. And on the other hand, the depositors will be running away from risk by withdrawing their money. And this may explain why there was over $100 billion being withdrawn from the bank. So, and by March, analysts and investors pegged its paper losses at between 9.4 billion and $13.5 billion. So this later shifted from 4.8, went high to a level of $13.5 billion. So with such a huge dip on the books, though there were not realized losses, then it eventually triggered the downfall of the bank. So with more withdrawals, eventually the bank would not honor withdrawals, and the bank collapsed. So this is just one bank. There are many more banks in the US that are holding a lot of unrealized losses, and this is the factor defining what we call the US banking crisis, which is unfolding every week. So knowing this and knowing that the crisis is getting bigger by the minute, then it basically implies that as a trader, you should consider your options and see what is developing in the charts. So in this case, if you look at the chart of gold, you'd notice, but for the last couple of days, this is basically the last 3 weeks, it has been moving sideways as investors were expecting that things had come to an end in terms of the banking crisis. However, if you take a better look and look at what has been happening in gold since the beginning of the year, then you notice that it has majorly been going up. So gold opened trading here in January. This was the price level of 1824. And since then, rallied all the way up, erased all the gains before rallying in February through March. And this has been the story of gold moving even higher. And right now, as I speak, I believe it's about, this is 8.61% higher from the opening price at the beginning of the year. So one of the reasons that you'd most normally see gold rallying or moving higher is whenever there is a crisis or uncertainty in the market. And in this case, we are very sure that there's a banking crisis brewing in the US as well as the rest of the world. We saw it happening with Credit Suisse in Europe. And this is a testament as to why a lot of investors are buying positions in gold to hedge their risk. We also saw some good rally happening in Bitcoin. So with this happening, then there has been a lot of bullish bets on Bitcoin as well as on gold. And if you are very keen on the charts, then you know that this basically means opportunities. So while the market has been moving sideways, it has made a lot of sense to be buying the dips in gold. It seems to be finding some very good support around 1978 and finding some resistance around 2000. But now we have very clear trend lines on this area here on the 1 hour chart and this other area on the 1 hour chart. So from here, you can see that early this morning, we witnessed the gold retesting the lower trend line here, as well as the 1978 price level. And once it hit here, there was a very strong bounce for 2 hours before the market started pulling back. So one of the reasons we are seeing this kind of pullback is because the dollar is still very strong. So while we are trading gold and expecting a continued rally, it's also important that we understand that the dollar index has also been pretty strong since last week. So as you can see, today being Tuesday, the dollar index is rallying. Yesterday was very bullish, but on Friday, managed to find resistance and pull back downwards. But this is a clear break from a trend that was holding for quite a period of time. And this is for the last 6 weeks. So for the last 6 weeks, we have seen some very good resistance here. And now we can see that the dollar index managed to break this resistance, pull back to retest the area, and then continue moving higher. So today it's in order to trade the weakness, the strength of the dollar, against other currencies. And this has been very brilliant when you look at other charts. So for instance, if you start with pound USD, you notice that it managed to break down lower on Monday. And today it's pushing down towards our target of 1.24460. Then we have New Zealand USD. This one is breaking higher, has been quite strong. So Asian pairs have been doing really well against the dollar, despite the dollar strength. And we saw it from the interest rate hike early this morning by the Reserve Bank of Australia, leading to this nice rally here. But since then, the dollar strength has begun to reverse the trend here. So looking at other pairs, Euro USD managed to break this strong support at around 1.09709, closed below, retested the area, and is now headed lower. So it's in order to expect that the price will continue going down lower to the next support level of around 1.09276. And as for USD CAD, we managed to see a very strong support around this area. And since then, it has already hit our target of 1.35889, and it seems to be moving higher. So we could be seeing the price rally all the way up to 1.36475. So as for USDN, a very strong rally. We know that the fundamentals are really weak for Japan. So a continued rally could be in order. So we mentioned that we're expecting a retest of this area here, 137.889, which is a level that was serving as the resistance here back in the month of March. So we are looking to retest this area and then observe the price action to see whether there will be a clear break or whether there will be the formation of a cap and a handle kind of pattern. So the cap begins here, goes down and then up, and now we'll be looking to trade the handle here, but you have not hit the resistance yet. So the bias is still on the upper side. So as for gold, from this bounce, the expectation is to go further upwards to 2000. But if we see another retest, then it could mean another re-entry in gold. So as for US equity indices, they seem really weak since yesterday. We are seeing the market putting back downwards, not since yesterday, but Friday. Remember, the market in equities was closed on Labor Day. So market opened, tried going up, and now it's putting back downwards. So our target remains on site, 41.39. US 30 managed to drop very well on Friday. Today attempted to go up and then pull back downwards. So it's in order to expect the price to go a little bit lower. So around this level where we had the previous resistance, it could be our support now, that is 30,857 being a very nice target here. So same case for US Tech 100 or the NASDAQ. So you can see the struggle that the chart is experiencing here. So from here, it basically means that it's in order to expect some form of breakout to happen outside this triangle. So as for UK oil, you can see we noticed some resistance here. So from this resistance, it seems that the price is attempting to move down lower, and we could be seeing some further downside. So as for now, the short-term targets remains on the previous lows of 77.393. So as much as we are seeing these, then there's a good chance we could be reaching this target here. And these is in comparison to the strength of the dollar. So as long as the dollar remains strong, then oil could retest the $77.393 level. So USD CNH, or the USD trading against the Chinese yuan, seems to be pretty strong. So as much as the market is expecting some form of interest rate hike tomorrow, then it's in order to expect that the market could potentially rally and get to the previous resistance before we see something else happening here. So European equity indices seem to be pretty weak. So for EU 50 or the Euro stocks, it seems to be strongly bearish today. So trading along the trend might be in order. So having bounced from this particular resistance here, seems like the market will be headed a little bit lower from the current level. So we haven't yet hit a major support level. So you can see we already broke this area here. So potentially we will be looking at this support here at around 4,323. So that's it for today. If you have any questions, feel free to type them and I'll be responding to those questions on the go. So also earlier this morning, we had a comment, and this comment was regarding a letter that was written by US Treasury Secretary Janet Yellen, basically addressing the Fed and saying that sorry, not the Fed, but Congress, if the debt limit is not raised or the debt ceiling is not raised, then the US could miss on its debt payments by the 1st of June. So this is quite concerning, but all the more we know how it works, we know the template. So whenever the US is very close on defaulting on its obligations, the Congress will always sit and agree to basically hike or push the debt ceiling higher. So the only problem is that this process tends to be heavily political. So they often wait until the last minute so that the guys on the opposing side get something out of it. So as soon as they pass a bill to push the debt ceiling higher, then they will be getting something out of it. So it's a Democrat Republican kind of play, but I don't think it's something to worry about in your trading. So that's it for today. Thank you very much, guys. Also, we'll be having another podcast episode airing tomorrow. So remember, the Bullish Banter podcast continues. So we have been doing a lot of episodes trying to cover different areas of the market. So we'll be having an episode coming up tomorrow. And next week's, perhaps, we'll be having a more detailed podcast covering what happened with First Republic Bank, the banking crisis, the interpretation, and a projection of what we see forward. So thank you very much, guys. See you on the next one.